This is not financial advice. I'm recording my thoughts about Constellation Software, ticker symbol CNSWF. The stock is currently trading at about $1,862. This is US dollars. And they have a market cap of about 53 billion Canadian dollars. So this is already a big company. In the past 5 years, the stock is up about 175%. That's more than 2.5x in 5 years, which is an incredible gain. And for the past 15 years, that is since 2008, this stock appreciated by 8,900%. That's almost 90x your money in 15 years. That is incredible gain as well. But if I buy now, can I get a good gain? That is my question. So in this video, I'm going to talk about the risk and reward of this company. I'll first talk about the business model, then I'll look at some numbers and their financial performance. And then finally, at the end, I'm going to do an evaluation with reasonable assumptions to see what is my upside, and based on that, I can make an investing decision whether to buy this stock or not. So Constellation Software, as the name suggests, is a software company, but it's a conglomerate of about 500 small VMS companies, which are apparently important companies, but they are much smaller in size. Constellation divided itself into 6 different subgroups, as I've shown on the screen. And the business model is that Constellation buys very small mission critical software companies for a very good price, like a price to sales of 2 to 3. And then they leave it to the management to continue executing. And they incentivize the management of these small 500 companies with stock. And then they make sure that the interests of the management of these small 500 companies align with the Constellation management's interests. So that is the business model. Constellation continues to acquire more and more small VMS companies, and they intend to grow their revenue as well as free cash flow with that. Let's look at some numbers now, including their financial performance. I would like to start with the shares outstanding. The shares outstanding are about 21 million. This company is not interested in diluting the shareholders. That is really good for the shareholders. And now let's look at their 2022 year performance. They made about $6.6 billion of revenue, as you can see on my screen. And the expenses are $5.7 billion. And the net income is about $550 million. But as you can see on my screen, they do include depreciation and amortization in the expenses, and it's about 143 million depreciation and 676 million amortization. So when we actually talk about how much cash they have, free cash flow, to acquire more and more companies or give it back to the shareholders, we have to add that number back. As you can see on my screen, they add that number, 143 million and 676 million, back to the 551 million net income to make about $1.3 billion of free cash flow. So even though they are showing 550 million net income off of their $6.6 billion of revenue, in reality, they actually have $1.3 billion of free cash flow without diluting the shareholders. So they can use this $1.3 billion to acquire more companies or buy back shares or give us even a dividend, right? So this $1.3 billion belong to the shareholders. Let's look at their cash position by end of December 2022. They have about $811 million of cash. And since they are already profitable and generating over $1 billion of cash flow, they don't need to dilute the shareholders or take any debt anytime soon. So the financials are in really good condition. Now let's look at the growth rate year on year. As you can see on my screen, I'm not showing the 2022 number, which is 6.6 billion. But in 2021, they made about 5.1 billion. 2020, about $4 billion. 2019, about 3.5 billion. 2018, about 3 billion. And 2017, about 2.5 billion. So if you look into the growth rates, they grew their revenue by 14% in 2019, 13% in 2020, 28.65% in 2021, And in 2022, they grew their revenue by 27.85%. We do need to understand that this is already a big company making about $6.6 billion of revenue. So for this company to grow, it's actually hard. Earlier, when they were small, they were buying the small VMS companies back to back and generating money. Now that they have $1.3 billion of free cash flow and they have already acquired a number of companies, they're finding it hard to find new companies that are worth buying. So that is definitely a challenge, and that is going to factor into their future performance. Yes, they grew their revenue by 27% this year, but in the coming years, growing at that pace is going to be challenging because they are already a big company. Now let's move on to the evaluation in 2027. And for that, I'm going to consider two cases. One case serves as a base case with reasonable assumptions, and I'm going to take my investing decision based off of that case. And I'm going to show another case with great execution. What if they execute incredibly? What is the upside, right? So let's look at the base case now. We do know they made about $6.6 billion of revenue in 2022. But for the estimated growth for the next 5 years, I'm assuming 15% growth rate. As I said before, as the company grows bigger and bigger, it's hard for them to grow. And in the past 4 to 5 years, the average growth is in the order of 20%. So as they get bigger, since it's going to be harder to grow, I'm assuming 15%. So if they can grow at 15% in the next 5 years, they can get to about $13.3 billion of revenue in 2027. That's more than double in 5 years. And the assumed net profit, I'm assuming 25% because they have gross margins close to 75 to 80%. And currently, their net income was $550 million out of $6.6 billion of revenue, right? That's less than 10%. But I'm going to consider the free cash flow margin here. They made $1.3 billion of free cash flow off of $6.6 billion of revenue. So that's about 20% margin, right? So I'm assuming 25% because I'm assuming they'll get more and more efficient in future. So you can also take that as an optimistic number, but 25% is reasonable for me. So with that, they can make about $3.3 billion of net income in 2027. For a company that's growing in the 15% range and have a net profit margin of 25%, I can assign a multiple of 20. But since Constellation is doing great, I can give a premium and assign a 22.5 multiple, with which this company would be worth about $74 billion in 2027. For the number of outstanding shares, they have 21 million. They're not diluting the shareholders, so I'm assuming that they will have the same share count even in 2027. They may do some buybacks, which is going to contribute positively, but I'm not assuming that at this point. So the number of outstanding shares would stay at 21 million now. With that, the 2027 stock price would be about $3,522 US. Wait, currently they're at $1,877, right? So that's about 88% gain in 5 years, which is good. That's going to beat the index for sure. But the growth rate of 15% and the 25% net profit margin has to hold. So one of the important assumptions of this evaluation is that they would not make any huge acquisition that's going to fail. So 88% is good. Now let's look at the case where they do great execution. For that, I'm going to assume 20% revenue growth year on year, which is very hard to do, but they could do it with great execution. And that's going to result in $16 billion of revenue and $4 billion of net income. And I'm going to assign a 25 multiple because they're growing faster. And that's going to result in $102 billion of market cap. And the number of outstanding shares are 21 million. So the stock price would be about $4,842 in 2027. So the 5-year gain would be 158%, which is incredible gain. So in the base case, we have 88% gain in 5 years. And in the great execution case, we have about 158% gain in 5 years. Both of them look attractive. Of course, there are buyers for this sort of business model, but personally, I do not like a business model where growth comes by acquisition because one bad acquisition, one large bad acquisition can ruin everything for the company. And I prefer to own a company with incredible moat and incredible value proposition that is dominating the market and taking market share away from other companies, right? So overall, Constellation, while the reward looks good, it's not for me. So I'm not going to be investing in this stock.